Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is February 25th, and this is Richard Bernoulli. We have a very special show for you today, a reconvening of the four horsemen, we call them. This is now the one-year anniversary when we had the podcast with the four horsemen just before the onset of the COVID pandemic and the beginning of the lockdowns. The four horsemen are David Rosenberg, Jim Bianco, Peter Bookvar, and Ira Harris. David founded his own firm, Rosenberg Research, after being chief economist and strategist at Gluskin Sheff. The firm offers extensive research and information services with a trial service that we will post up a link to. He also served as chief economist for Merrill Lynch and one of the 12 smartest people on Wall Street by Business Insider. And Jim is president of Bianco Research. Since November 1990, he's been producing fixed income commentaries with a circulation of hundreds of portfolio managers and traders. He's regularly featured on Wall Street Journal, New York Times, Barron's, Business Week, Forbes, Fortune, CNBC, CNN, Bloomberg, and Fox News. Peter's the Chief Investment Officer for the Bleakley Financial Group and advisory at Bleakley. He has a newsletter product called The Book Report, BOOKREPORT.com. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. And Ira's independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He's also served as CME director from 1997 to 2003, and also most recently. Great, welcome, gentlemen.
For having us.
Great to be back.
Thanks, Rich.
Maybe we can begin with an overall current view of the economy and the financial markets in general, and how it has evolved over the past year. And Jim, your thoughts?
I agree with what David said, that there is no inflation now. And really what the market is betting on is that inflation will materialize, especially in the second half of the year. Any inklings you get of inflation over the next 60 to 90 days has a built-in excuse, the base effect. We all know that the numbers are going to go up when we drop off April and May of March and April of last year, as well too. So the bond market is trending higher, and the story of 2021 is why. And I've argued it doesn't matter, or higher rates are neither bullish or bearish for equities. It's why they're going up. If they're going up because of the Powell argument, which he reiterated the last 2 days, is that real growth is coming back in a big way, and this is a validation that everything is getting better, then the market will be fine with higher rates. If there's some latent fears that inflation is going to come back into the system, then the market will have some indigestion with higher rates. And that's beginning to see what we've seen in the last 3 or 4 trading days. I mean, up through the end of last week, you really didn't have that in the markets. You do now. It remains to be seen whether or not this continues. My take is we are going to see some latent inflation after we get the base effects. Where I'll differ from Dave is I agree that the $1.9 trillion stimulus package is going to fill the output gap. But then I think we're going to keep piling on it. I think as soon as they get this thing done, they're going to take a breath, and then they're going to start on a $2 trillion infrastructure program. And then when they get that done, they're going to take a breath, and they're going to start on another program. And we're not going to stop with these programs until there's a consequence to them. One of the consequences could be inflation. One of the consequences of them could be sloppy markets. But if you give people $1,400 checks, and all the public sees is the poor got some money, the unemployed got a bridge to a job, and the rich, defined as people that own stocks, got new highs, then send me another $1,400 check. Unless there's a consequence to this, I think that we're moving ever closer and closer to UBI. And I'll remind you that it was no less than Mitt Romney that has proposed that we start paying people that have kids under the age 18 monthly, starting at $300 a month, depending on what age your kid is. And I'm sure he'll get a wonderful audience for that in the Democrat Party as we move forward from here. So I fear the inflation story, although I would caveat, we don't have it now. And I think that that's what the bond market's starting to fear too, is that it's around the corner and it's coming. The last thought for you is about inflation. Remember, it's been since what, the mid 90s, since we've really had true inflation to actually consider in the markets. It's been a very long time since we've seen it. And a lot of people are not sure what inflation looks like because it's been such a long time to see it. And if we get it, we're about to relearn the lessons of inflation all over again.
Interesting. And your thoughts, Jim, in terms of Asia commodities and indicators of inflation or deflation?
Yeah. So first of all, on what David just said, we've looked at the tips break evens too, and you're right, David. They're terrible indicators about what eventually happens. And we used to joke, thank God that that God invented economists, because they're the only group that's worse than the tips break evens. So that tells you how bad they are.
Can we be worse than zero?
Yeah, exactly. Well, that's like I like to say, the worst you can be is random, right? You can either be a fade or you can actually be a right. But the worst is when you're random. And that's kind of where the tips break evens and the economists are, is they're random. They get just enough of it right that you can't do anything with them at that point. But as far as commodities go, yeah, there's been a very strong bull market in commodities, especially my new favorite indicator to look at is the CRB raw industrial spot. It's industrial commodities. It's largely commodities that don't have futures contracts tied to them or small futures contracts tied to them. So they're not just caught up in the whole flow of funds game as well, too. And I like to joke with the CRB raw industrial spot. If you know what tallow is, you win a door prize. Because it's one of them in there. But that index is booming. It is absolutely going vertical. It's at a 10-year high. Copper's at an 8-year high. As well, too. So you've really got a real strong uptrend in commodities right now. But to the point that, kind of squaring the circle, I think we're going to see some inflation next year. And by the way, I need to put a definition on that, the inflation that I think we're going to see. I've been saying to people, the core PCE, a Fed favorite measure, my target is 2.6. 2.6, that's not inflation. That's a 28-year high. It hasn't been at 2.6 since 1993. It was the last time it's been higher than that. And I've said, if you give me 2.6 on core inflation and we push real yields back to positive, you could be talking about a 3% on the 10-year note. If you look at the bond market and the structure of the bond market and the leverage in the bond market, 3% is a lot of pain. That's going to be a lot of pain in the bond market. I understand equity guys, 3%, come on, that's still a low yield. Yeah, but look at the long durations and the convexities in the bond market and look at the losses. Look, the 30-year bond is already down 17% this year. Year to date, it's down 17%, and that doesn't even include today's wipeout. I don't know where it's going to be when it gets updated tonight. But this is going to cause a lot of pain, even if you were to get back to 3% in the bond market. So I've been looking at this idea about inflation coming back and moving higher, and the commodity prices have been confirming of it. Now, one thing to be clear about this, I've tried to differentiate between reflation and real growth and inflation. And I like to say that bond yields move on expected nominal growth, wherever nominal is going to go. And it's hard to tell the difference between a market that is discounting reflation or real growth, because you get wider tips break evens, you get booming commodity prices, you get people thinking the economy's coming back, you get cyclical stocks to outperform, and inflation, because in the beginning stages of that, you get the same thing. And it's only once it matures does it differentiate itself out. So it's hard to tell right now which one the market is going at. But I've also come back to this idea that 2.6, that's all I need. And it's a 28-year high. And the last thought about 2.6, a lot of people say to me, yeah, well, the Fed has already said that they'd be willing to tolerate 2.6% inflation or 2.5% inflation. And I've always said, it's not the Fed's call, it's the market's call. The inflation rate will go to whatever level that the market has decided it's too much. And then the market will force the Fed. Think about the last two Fed moves. A year ago in March of 2020 and in December of 18. In both instances, the Fed thought that they were on hold. The markets threw a fit in both instances, and within 10 days, the Fed had changed policy. The Fed was on hold in their March FOMC meeting, and then the markets puked on themselves because of the pandemic, and within 10 days, they cut 50 basis points. In December of 18, Powell said, we're going to reduce the balance sheet by $60 billion a month. It's going to be an automatic pilot, like watching paint dry. The stock market puked on itself. January 4th, he comes out and says, no, now we're patient and flexible. So Fed policy will be driven by the markets. As commodity prices go up, if it takes hold that we have inflation and the bond market keeps puking on itself, I think that the Fed will be forced to change itself. One last thought for you. I've also argued, too, that in an era of inflation, in an era of reflation, if the Fed wants to suppress interest rates, the market will be very tolerant of it. In an era of inflation, if the Fed wants to suppress interest rates, that will be taken very badly. Last night, yesterday, Thursday, Reserve Bank of Australia, the RBA, stepped in and bought bonds, QE'd more on yesterday than they did. They equaled the high they did during the panic of March of 2020. So they basically, the RBA came in and said, enough of the rate rise. We got to stop this. And they started buying bonds last night. Yields went up 11 basis points. They threw up all over themselves. If this market's worried about inflation, every time the Fed steps in to stop the rise in rates, it makes it worse. Now, that's just one instance in Australia one time. So it's not a trend, but if we continue to see more of that, then it tells me that the market is really coming around to this idea of inflation and that the rise in commodity prices is not necessarily reflationary, but might be tipping over to inflationary.
Interesting. And final question, given this economic and financial environment we have discussed, where are the investment opportunities? Base metals, precious metals, energy, agriculture, Asia, and or bank equities with good dividends and good risk management? Maybe we can begin with Jim. He may have to leave shortly. Jim?
There we go. Yeah, so I'm going to give you a couple of, out of the box ideas here. Idea one is go with what's working right now. And I think what's working has been the commodity trade. I just don't see it ending right away. I get that we might be a little bit frothy on it. Go with the higher rates trade. Way that you could play that other than derivatives for betting on higher rates would be to own financials, especially banks. I'm not a big fan of banks long term, but they are a high beta play on interest rates right now if you wanted to play them. Third, if you want to real outside the box, and I am a big fan of what's happening in the space, is go with cryptos. Because I think that what's happening in that space is truly revolutionary. It's coming in a big way, especially in the altcoins away from Bitcoin, when you start getting into Ethereum and Binance and some of the other coins as well too. If nothing else, if you're a little bit afraid of investing in that space, spend some time to understand what's going on there. Because I do think that the next big disruption in the economy is going to be the financial services sector. And it's going to be led by this digital move that we've been seeing with these coins. So, commodities, interest rates, play higher commodities, play higher interest rates. You play the banks if you don't want to play some kind of inverse on the bet on interest rates, and maybe take a look at some of the cryptos as well too. If not invest in them, at least try to understand them with an open mind.
Great. Thanks, Jim.